All righty. Perfect. Well, hello guys. Welcome to another episode of Paris and Baz Cast, where we bring to you new guest speakers every week to talk about topics that impact property management, sales and finance. Topic of discussion today is going to be more relevant to a wider audience, given that every working person has to lodge a tax return. And there's been a lot of changes this year with working from home. So we're just going to be talking to Manjot Singh from West Hill Partners. Hello, Manjot. How are you?
Hey, good to see you again.
How
are you guys?
Good. And the topic of discussion today is tax returns and the type of what we need to consider this year, especially that part of the year has been impacted by COVID and the fact that a lot of us have worked from home. What are some of the things to consider? And I've actually got a question already. Well, there you go. So before I just start off, I'll come back to you, Lakshay. We're live on Instagram and on Facebook. So feel free to ask any questions as you watch the this live stream. So to start off, if you want to just give us a bit of background of, given that end of financial year is approaching, what do we need to look at?
Yeah, just a quick one before we go ahead. I think I can hear my volume. I can hear myself. Headphones.
You can put the volume down on one of them.
Yeah, I've got the volume down on one of them. I can hear myself back.
You can hear you twice, can you?
Yeah, it's coming from your end.
Double check the way. No, you're loud and clear on Facebook and loud and clear on Instagram. If anyone's having any issues with audio, do let us know. But based on what I can see, I think we are good to go. As long as you can hear.
Yeah, no, I just can't hear my volume back. That's all good.
That's all right. We can hear you.
So, okay, I just want to start off by saying, first of all, this is an information-based segment. So it is not advice. And if any of it applies to you or benefits you, you need to first consult your financial advisor, your tax agent, or your accountant. You know, so just a bit of a disclaimer there, because it is all information based from the resources of the ATO. So, you know, like you said in the introduction, so the main one we'll touch base on is working from home expenditure this year. So working from home, just want to give everyone a brief rundown. So, you know, in the normal circumstances, you can claim like your electricity bills, your cleaning expenses, your phone costs, internet costs, printing paper, the printing ink. You know, if you've bought a computer, a laptop, or you've got an iPad for work, you can deduct the decline in value or the depreciation and all that. So there used to be two methods, or well, there are still two methods in the normal circumstances, which is the fixed rate method and the actual cost method for claiming such expenditure. But what the ATO has done due to COVID-19, due to the coronavirus, is they've introduced a shortcut method, and that's what they've called it. Okay, so this is the shortcut method. So if you've been working from home between the 1st of March and the 30th of June this year, you can claim 80 cents for each hour that you've worked from home. Okay, so for example, if you calculate that you've worked 2,000 hours from home from the 1st of March to the 30th of June, you can claim, you know, times that by 80 cents, which is $1,600 basically, you know. And so, I mean, this is a simple way to approach it. That's why they called it the shortcut method. You don't have to go down the path of calculating the exact electricity, the exact phone cost, internet costs. You just work out the total number of hours, multiply it by 80 cents, and get your deduction figure. Right? For this particular method, they're saying you don't have to have a designated area in your home where you're working from, as long as you have some sort of substantiation, such as a roster or a timesheet diary or a similar document to prove the number of expenses, the number of hours actually that you've worked. Lunch breaks, or if you've helped your kids, do their homework, all of that, obviously you have to exclude. It's primarily the hours that you've spent on working from home for your employer. Okay. Yep.
You continue.
All right, cool. So I do want to say that when you're claiming all these expenses under the working from home guidelines, you need to make sure that you're not being reimbursed for such expenditure from your employer. Okay. Only then you can claim it. Or the other thing is they might not reimburse you. They might give you an allowance, which they will, declare on your group certificate or your PAYG payment summary.
Yeah.
Then you have to include those allowances as assessable income and then claim the deductions in the expenses section of the tax return. Yeah.
Interesting. So one of the questions that we had here was, can you claim your car as a marketing expense for a social media agency business? So Lakshay, this is your...
Yeah, so we'll come back to that one. Yeah, I read that one on Instagram. We'll come back into it in the next section after working from home. So, the question is, okay, what happens before the 1st of March? You have working from home expenses before the 1st of March, from the 1st of July last year. You can still use the other methods, which is the fixed rate method. So the fixed rate method is allowing you to claim 52 cents per every hour worked. And this is the one they've increased to 80 cents after the 1st of March. Okay. But, digging deeper, like you just have to be mindful that the 52 cents per hour method only includes electricity and the decline in value of capital items such as home office furniture. It doesn't include phone, internet, printer, and the decline in value of, your laptops or computers. So 52 cents in the hour, you can claim for electricity and the decline in value of capital items such as home office furniture I just mentioned. And then all the other stuff, you have to work out the actual cost of and add it to the 52 cents per hour calculation there. And the third one is, which is a difficult one. You have to calculate the actual cost of all this expenditure. Yeah. Okay. So for example, if you're trying to work out the actual cost of electricity, you need to have a designated area in your house, like a room or something, like a study, like you guys have behind you, then you need to work out the square meterage of that compared with the square meterage of the house. And then, go into the calculation of multiplying that percentage by the actual electricity bill. So that's the actual cost method. So the fixed cost method, the actual cost method, and the 80 cents for each hour you work from home since the 1st of March, whatever method you use, obviously you need to consider all these methods because one might give you a higher claim than the other. Okay.
Does it matter how old the asset is when doing the depreciation, or that doesn't?
Well, yeah, it would be understood that if the asset that you've purchased, if you've purchased it in the past, in the previous financial years, you would have claimed it in those years. That's what people do. Primarily, it should be purchased or bought in the financial year that you're claiming it in. Yeah. Just want to point out that you can't claim rent, you can't claim the interest on your mortgages, you can't claim water rates and council rates. So just want to mention that again. It's electricity, decline in or depreciation on your home office furniture, cleaning, phone, internet, printer, and all that. But like I said, if you're using the 80 cents per hour, it's just a simple calculation based on the number of hours that you've spent working from home.
That's interesting. We have our house accountant.
So people are asking, okay, even though I have been working from home, but I have been going into my office, or into my workplace, can I claim the travel expenses? No, you can't. You can't claim travel to and from work if primarily, you have been working from home. So all of that stuff, all the travel stuff, you won't be able to, unfortunately, claim.
Traveling for work. So, for example, if you're doing inspections, is that still something that can be part of work?
Yeah, if you,
for example, with the real estate agency, we're inspecting rental properties. Is that something that's considered?
Yeah, absolutely. Look, if you're going from a workplace to a workplace, all of that travel is certainly deductible. But what they're saying is people can say, my house is my workplace.
Yeah.
and I'm going to my workplace, you know. So, but your house, they're saying, is not your workplace.
Yeah.
So your house is still your house, and if you're going from your house to your workplace, unfortunately, you can't claim that.
Yeah, so you can't consider your house as your workplace and going to another workplace as a claimable.
Yes, that's right.
Yeah. Okay. Interesting. There you go. Still working from home?
Now, so I think that's pretty much it from working from home. You just have to make sure whatever method you use, you have the right documents, the substantiation in place to prove your claims. I just want to mention that do ask your tax agent or your financial advisor or your accountant these questions, you know. Why don't we try another method if that brings a larger claim, or, you know, as long as it doesn't affect anything else. So there's three methods there that you can ask your accountant to use and work out which of the methods is the most beneficial.
Yeah. Perfect. There you go. Okay, so that's one part of it. So what's the top tip number 2?
So moving on, we did discuss in, I think 2 months ago, in one of our JobKeeper and the other grants we discussed with you guys. I just want to touch base briefly on that. Taxpayers need to be really careful with the grants that have been issued to them over the past 3 or 4 months. For example, if they've received a JobKeeper payment, so if the employer has received a JobKeeper payment, the business, the sole trader or the company, they need to declare the JobKeeper payments as assessable income. Okay. Yeah. So JobKeeper is assessable income. Businesses that have received the cash flow boost via the PAYG lodgements, the cash flow boost is tax-free. Okay. Right. So some of these grants are taxable, some of these grants are tax-free, and why they are tax-free or taxable, there is reasoning behind it, which we won't go into, but you know, you need to give careful consideration to what sort of grants, whether the state grants as well, you know, that you've received, are they assessable or not assessable? And if they're assessable, you need to be prepared and ready to be able to declare them as a part of your income on your tax return.
Yeah, yeah. And the instant asset write-off, that's obviously still, how does that all work again?
Yeah, so that's the next point, and I think we'll answer that question that came through on Instagram as well, through the instant asset write-off. So the instant asset write-off, we did discuss this earlier in our previous segments. So businesses can claim up to $150,000 worth of business assets as long as they're installed and ready to use. They previously said installed and ready to use before the 30th of June this year. Now that has been extended till the 31st of December this year. Okay.
For example, if a large machinery has been ordered and you know, hasn't yet arrived, you can't really use it. Right,
Yeah.
okay.
So, but the only thing is then that claim will go into the next financial year. So it's $150,000 instant asset write-off for businesses earning $500 million or less on an annual basis. Obviously, if you've purchased something before the 30th of June, it's installed and ready for use before the 30th of June, that will go down as a claim, as a full deduction up to the $150,000 in this year's tax return for your business. Now, coming to that question, passenger cars.
Yeah.
All right. So passenger cars that have a carrying capacity of, you know, tools and everything else less than 1 ton, they will be deemed as falling under the car limit, which is $57,581, you know, 57,581. You can only deduct cars up to that car limit of 57,581. Okay.
If your car is worth more than that, then it's not.
Well, you can't deduct the extra value of whatever's above that particular figure that I just gave you guys. And that question that came through, if it is a passenger car, it is carrying, even though if it's for a marketing agency, if it's a passenger car, it's able to carry the 5 passengers, then the car limit will apply. You can still deduct the car up to that car limit. Okay. Yeah. We've had just wanted to mention as well, we've had a lot of questions, okay, I'm going to go out and buy this. I'm going to go out and buy this. I'm going to save a lot of tax. What's your take on it? At the end of the day, these things aren't coming free.
That's right.
You're still going out there and spending money on it. The tax saving will come, but the tax saving is only a percentage or a proportion of the item that you've bought.
Exactly. You've got to have a bigger outlay.
Yeah, and so what I'm telling people is the mindset is, yes, I do need this. Okay, it is going to increase my business productivity. It is going to increase my business turnover. Because that's the right approach. Tax saving is not growth at the end of the day. It is the top line which increases and then is considered growth for your business. So if you're just going out there, I just want to save tax and buy stuff, you need to be mindful of your cash flow. Do you really have the money? When the whole market is struggling, you need to be able to have the right cash flow in place as well over the next period. So, it's important that you look at it. Okay, I'm going to get this asset. There is a tax benefit there. We're going to make use of it. The tax benefit would have been there anyways. It's just that you would have had to deduct it over a certain number of years. The ATO is allowing you to deduct it all of a sudden. But the right approach, the right mindset is, do I really need this asset to help my business grow and help my business productivity?
Yeah.
Okay. That's really important. Should we go to the final thing?
Yeah, the last one. We're just mesmerized listening to what knowledge.
The final one, sorry.
Yeah, I was just going to say, if anyone else has questions while we are live, we are actively looking at Facebook and Instagram as questions are coming through. So if there's anything that you'd like answered, do let us know. If we don't get to you during the segment, feel free to ask them afterwards as well. We'll be happy to come back.
Yeah, absolutely. The last one is super contributions.
Yeah.
Okay. So every year, if you're making contributions up to the concessional contributions cap towards your super, you're able to deduct whatever you've paid towards your super as a concessional contribution. Okay.
Yeah.
The concessional cap has been $25,000, and it will be $25,000 for the next financial year as well. But 2020 is the first financial year where they're allowing you to carry forward unused concessional super contributions.
Wow. So does that mean that if you've only done about, say, 1,000, and you've got the rest of it, carry majority of that? Or
yes. So if the $25,000 or a part of the $25,000 has been contributed towards your super, then the remainder up to the $25,000 can be carried forward. Let's just say, for example, you did not contribute anything this financial year. Okay. Next year, it means you can contribute up to $50,000. Okay. So the next year, your claim will double, and the way to look at it is you need to look at your income here, right? Now, obviously, a lot of people have lost their income due to the coronavirus. So it may be in their favor to carry it forward to deduct a larger claim from a larger income next year. That might be one strategy, just as an example, that taxpayers might want to implement as far as these super contributions are concerned. So, prior to this year, if you did not contribute up to the $25,000, you couldn't carry the unused cap forward. They're allowing you to, from this 2020 financial year onwards, to carry it forward.
Do you think it's also got to do with the fact that how some Australians have taken out up to 10,000 from super, so it's an opportunity for them to sort of return back more, or does that not really make a difference?
I mean, look, if they've taken it out and if they want to contribute it back, and of course they can. I think this particular segment that we're discussing, super contributions carrying forward, it was implemented before this whole virus hit. So I'm not sure too much about the reasoning behind it, but they are allowing you to carry it forward, and it's important taxpayers pay careful consideration to that as well.
And do you think there's a potential for it to become a norm in the future? Like if it works well, because obviously there's always that push to be able to contribute more towards super. So if that's going to continue, then it makes sense.
Yeah, look, at the moment they're saying it is there to stay for the next 5 years. Okay, so your unused super contributions or unused super contributions cap will expire after 5 years. You know, if there's a change in government and things change, or change in environment or economy, we don't know what's going to happen.
Yeah.
But it is there to stay for the next 5 years.
Okay, there's top 3 things that we've learned today.
There you go. What a knowledge, man.
I do want to also mention before we knock off, it's best if you get in early. If you see your tax agent or accountant early this year. It's just that there will be a lot of scrutiny from the ATO side of things. That's just going to delay processing times. For example, in my situation, I've had a lot of calls from clients who wouldn't normally come and see me for tax returns. You know, we would just do it remotely via phone or email. Right? Yeah. But this time around, because there's a lot of information, they want to come and see me, right? And face-to-face discuss the options available to them. So accountants, you know, will be meeting pretty much with every client, and that'll make accountants busy as well. The tax office will be busy. Like I said, paying close attention to the claims, and obviously the processing times will be slow. So it's better to book your appointments in and, you know, just be proactive about it. That's what I'm trying to say.
Get in there early.
Yeah.
Perfect. Any final words otherwise from you?
No, all good.
All good.
Yeah.
We've learned a lot. I think we do need to contribute more towards our super as well. That's one of those things that we put on the too hard basket sometimes. But there you go. Well, thank you so much for your time.
No worries. Thank you. Thanks, guys.
We'll see you guys next time. Thank you.
Bye.
Bye.